Thank you.
Hello, everyone. So maybe what we'll do is just start off with a couple questions, just kind of broadly speaking about how these two investors who are very focused on private investing within different parts of the AI ecosystem. But I think maybe as a starting point, maybe just for both of you, maybe just a brief introduction about what you do, what you're focused on, and kind of how you're looking at the landscape today. Hirsch, you want to start off?
Yeah. Sure. Hey, everyone. My name's Hirsch. I'm an investor at NFDG. We're a multi-stage firm that invests seed to growth, primarily in AI, but also in other domains. And I run this thing called AI Grant, which is an early-stage accelerator. We built our own GPU cloud called the Andromeda cluster. And we have been investing in AI since early 2022. And so for many of you, and for me, it feels like a decade ago at this point. So this was pre-Stable Diffusion, pre-ChatGPT. And having seen the trajectories of some of these companies since then, going from $0 to $100 million in ARR in a year or less, it's truly mind-bending. And I think that's some of the topics we can get into later, but it's a pleasure to be here.
Thanks. Sarah?
Hi, I'm Sarah. I'm a principal at ICONIQ. We are a 21 billion venture and growth fund. I joined 6 years ago in the US and now live in London and help lead our efforts out here. We invest from the early stages of product market fit all the way through to IPO and beyond. And I think similar to kind of what Hirsch said, have been seeing AI, I think, integrate into every kind of company. And so even if some of these AI native companies have only come up in more recent years, which has also been a focus, also just seeing companies that are, cloud native SaaS companies really thinking through how are we going to have AI enablement as a core advantage has been another key focus of ours.
I guess, one starting point for the question is, like, if you think about the private capital markets, some of the valuations that we've seen have been really unprecedented. Really, if you look at almost any super cycle, this is really unprecedented valuations that we're seeing. So as you kind of think about the traditional valuation metrics that you're looking at, how do you think about that? And maybe Sarah's a good starting point. Like, it's not traditional KPIs, yeah. So how do you think about that?
It's definitely something that we are grappling with. And I would say, like, at the core, some of the fundamentals that we actually are looking at haven't totally shifted. Like, we still want to invest behind category leading companies and figure out, how do we think we know which one that winner may be. You're still looking at, what is the scale of this company? How fast is the growth? How much are they burning? How much, are they retaining their customers, et cetera? I think what is difficult is the benchmark of what great looks like continues to supersede itself. And so in part, perhaps as a result of that, you then see, if growth is just at unprecedented levels, how do you value that? Because naturally, those multiples are going to look uncomfortable in several dimensions as well.
Hirsch, how about yourself?
Yeah, I think there's two things sort of driving the frenzy. One is the size of the opportunity. You've heard so many things about, we're creating intelligence. Intelligence is a replacement for not just software spend, but labor spend and other things of the sort. And the biggest companies in the space have reached unprecedented private market valuations. OpenAI at reportedly at $300 billion, Anthropic at 60, probably going to raise soon at a much higher price. Cursor, reportedly getting close to 20. At least people are fielding them offers. Perplexity at 14, and so. And these companies, or maybe not Anthropic or OpenAI, but the other ones are all 2 to 3 years old at the most. And so you're seeing people say, okay, if I have a chance of getting that big, I can sort of discount that down, but I'm still investing it in a crazy multiple compared to the age of the company, the amount of traction, or whatever it is. But the other thing you're seeing is just like the rate of adoption and the rate of growth of these companies is unprecedented. And it's partly because the distribution rails were laid over the last decade, mostly via social and the internet. And so everyone who wants to be an early adopter quickly finds out about stuff, can try it incredibly easily because a lot of these things are prosumer, and so you just put a credit card down. There's no long enterprise sales cycle. And then you sort of, I don't know if you guys are familiar with the IPCC, like, climate, how warm will the earth get? And you see this like line of historical. And then with AI, it's sort of like, okay, everyone's going to use it, burn down the rainforest, like we're going to go like this. and then, or it could like flatten out, or it could go up and then down. And so we're investing sort of at this point where we have no idea what the future looks like, but there's a very real chance where it continues to go parabolic. And your job is a very asymmetric job where you're supposed to find the 100x winner, not necessarily the 2x winner with certainty. And so because of that, you can end up discounting back and give yourself a very aggressive valuation multiple, because if you keep growing, you're going to make it a reasonable multiple in a span of a couple months.
I mean, when you think about the unit economics of these businesses, they're just very different, especially the cost structure of these businesses are also very different. So maybe, Hirsch, for yourself, when you think about, for some of these companies, just in terms of, sustainable business models, like what does that look like? Because they're very different than a typical software company, than a typical SaaS company. Like, how do you think about what is a sustainable business model for a company that is 2 years old, that's gone from 0 to, $300 million in ARR?
Yeah,
how does that look?
I would actually argue that the unit economics on a gross margin basis can look like traditional SaaS. 80% plus gross margins, and those are actually quite nice. Now, as you move down the income statement to other line items, particularly CapEx and R&D, especially if they're training their own model, it can be quite expensive. And so then you have to really think about, okay, does that, money we're spending on talent or compute allow us to extend our lead, continue to have the best product in the market, and to sort of build that flywheel such that you sort of outpace your competitors, and then your business grows, and at that point, you're amortizing down that big spend to something reasonable. There are very popular sort of AI products that do have 10, 20% gross margins, don't get me wrong. But a lot of times they're just doing funny accounting where they're including all of their free tier compute in the COGS line item, and maybe they should move it to sales and marketing. And then if you looked at just the paid, it's again back to 70, 80%. And so I actually think AI companies can have really good looking unit economics in the fullness of time, or even immediately, but there's some interesting trade-offs you're playing.
Sarah?
I think a lot of that resonates. Something that has been a bit interesting to see, maybe just on the gross margin point, is just depending on where in the stack the company is playing. I think the highest cost, for the gross margins are going to be the API calls to other models, and so in some ways there's this almost like oxymoron where the companies that their users are actually using the most AI, they're getting the most calls to the models, will actually have the most compressed gross margins, versus a company that has some AI embedded but isn't necessarily as core to it, maybe is not actually getting as much usage of that. So I think that's kind of one interesting area just that I've been trying to grapple with overall. But I think in terms of the unit economics, it's also interesting just to see a lot of these costs are continuing to go down, and I think a lot of companies are playing around with their pricing models as well in terms of, what do we need to be charging to make this a sustainable business model? And I think hybrid is really emerging as the number one. I think outcome pricing a lot less so. It has a lot of hype in the market, but a recent survey we did, I think it was like 6% of companies we surveyed were actually doing the outcome-based, but kind of combining usage with seat-based seems to be where a lot of things are going. I think in part because if you are, having a cost per model call, et cetera, then you have to understand what is the usage, because that's driving directly into the actual business models too.
Do you think that changes?
I think more shift to hybrid from the pure seat-based models. I think that's where it will continue to shift towards. I think pure usage-based, probably not. That still is difficult. And we recently published a report just around what our AI builders using, and that was kind of what the data showed as well. I think it was like 40% were doing the hybrid.
The ICONIQ report is spectacular. Definitely go online and check it out. I think it was published last week. One of the other things we see that I personally, when I look at an investment, is I don't mind if you actually have a very high amount of inference spend, and that's because due to the generosity of the venture capital markets, you can fund it, and then on top of that, the people at NVIDIA or AMD or Etched or wherever it may be are significantly decosting the cost of a token every year, every chip cycle, and we're also seeing algorithmic improvements. And so what ends up happening is, like before, if a million calls cost you $1,000 or whatever, a year later it's going to be like $100. And so you're seeing a 10x improvement on the inference cost every year or so. And so fine, if you had 80% COGS, it's now 8. Fine, maybe now you can use a lot more calls because you can throw more intelligence, more, in clever ways to improve the performance threshold of your product. And that will just let you win in the market. And it'll be this ever-ending game of use more inference, use more compute, use more intelligence, figure out how to decost it, do it again. And I think the math will all work out.
And Sarah, from your perspective, you see a ton of deal flow at ICONIQ. How do you think about companies that are either AI native versus those that are just adding AI features to existing SaaS products? It doesn't matter.
Yeah. Again, I think part of it ultimately also ends up being on when was the company founded. But I think, you can see companies that, we've invested in within the cloud era that are still kind of well positioned to be, really ushered into this kind of AI native era. I think the way that I kind of view the world is, we had this shift from on-prem to cloud, which was a huge catalyst for a lot of these technology companies to come about. A lot of those companies already have a more modern architecture, which makes it so you actually can build AI on top and embed that into the product and the workflows in a way that is helpful for customers, which is, very important. And then if you kind of shift to the future, I think we're seeing another one of these transitions from, cloud to AI. And I think a lot of the companies who were maybe started kind of in the era of the cloud are recognizing we need to move forward. We need to become, an AI company as well. And then you obviously have these new AI native companies popping up. But I think what is, more similar across both of those is what is fundamental is what is the core competency of these businesses? What is the key business pain point that they are actually solving? And if that is resonating, then it can be AI native, it can be AI enabled. Some already have the distribution and are modern and are able to, really build that out in a way that is strong. I think Intercom, which is a portfolio company, has done that with Fin, for instance. And then equally, you'll see, some of these new problems that maybe were almost unsolvable pre-AI, more likely to have more of those AI native solutions kind of coming up.
Cool. Hirsch, as you think about when you're looking at AI companies today, what gives you confidence that they just won't be disrupted by the next generation of models? It's like the idea of TAM, I think, is a little bit different in this cycle than what we've seen in other cycles. And then how do you just go about evaluating defensibility in just a really rapidly evolving environment?
Yeah, I'll take that backwards. From a defensibility point of view, the only defense you have is great offense, and by an offense I mean not spies and other things, but I mean just the velocity of the team, the quality of the team, and the ability to ship, listen to your customers, iterate, and press your advantage in the market. There are some cases where over time you can build a data advantage that allows your product to be better, especially now with new RFT fine-tuning techniques for some of these reasoning models, but at the end of the day, it's a very competitive market. Capitalism works. There are a lot of smart people out there, and you really just have to push. In the fullness of time, otherwise entropy takes over.
Sarah, how do you think about it?
I think maybe two different points, and I think it varies a little bit, again, depending on where in the stack you're playing. I would say on more of the AI application side, 100% you need the fast product velocity. That is crucial. I think that's always been crucial. I think it is, again, thinking through, how have you built up a just defensible solution in terms of what is the core competency that you're solving? What are the depth of those integrations? What is the trust, the accuracy that you are able to provide? How embedded in those workflows are you? And then you can, have AI as a real enabler and make sure that you're still pushing that forward, using the most recent models, et cetera, to just continue that edge. But I think there's, for instance, we've invested a lot in the office of the CFO. A lot of those businesses, one of the hyperscalers isn't going to suddenly go and build out a business planning software because that's not their core competency. And there's been a lot of depth built into that initial solution that is still going to provide some defensibility to what they have built. And then you have to really push the envelope in terms of how do you build build AI on top of that. I think on more of the infrastructure layer, completely agree. I think what we've seen in some ways is that, given the tooling needed for AI is different in some ways. There's new categories popping up like every single day. You suddenly have 50 companies, maybe more, started of like, okay, we're building a vector database, we're building MCP, and then you have to figure out, okay, maybe I got a lot of engagement and I got a lot of virality from this core product, but then how do you actually think through what is my act 2, what is my act 3? Because some of those tools may ultimately be eaten up by some of the larger players who want to provide like a broader toolkit as well.
And then from the point of view of the foundation model companies, you have to model them as a bunch of really smart technical folks that like to do beautiful and elegant things and don't like schlep. And so, in a world where you're building something that looks like an API endpoint, is sort of digital only, and is not schleppy and is sexy, they're going to be excited about doing that. And so you're seeing this sort of okay, we have foundation model companies building coding models. They're not building coding products, which are competing with people who use the API to build coding products. But in something like customer service, you don't see Anthropic pushing that direction, because you have to go talk to a non-technical buyer about non-technical things and do a lot of handheld, high touch implementation and get it set up and have a prolonged implementation experience with them. And that's just not fun for people trying to build AGI and a new god or whatever it may be. And so Sam Altman always this thing of don't pick up quarters in front of a steamroller. I think that's true. But the steamroller is only so wide, and there's a ton of stuff that they're not going to drive over, and so there's a ton of opportunity still out there.
And maybe kind of drilling in just a little bit more, obviously I think looking at 5 years is almost just too long of a time horizon because things are just changing too rapidly. But if you look out over the next 2 years or 3 years, what are you most excited about? What are verticals or either opportunities that you see are being really interesting areas?
I mean, personally, the intersection of AI and machine learning and biology as an area that will have a real and significant impact on our day-to-day lives. You sort of forget about your health until you are sick, and then you're like, oh, I'm so glad we have ibuprofen. The new thing that we're seeing in the world is GLP-1s, right? And people are able to take control of their weight and all the comorbidities associated with that because of it. And there's biology is this incredibly complex, multidimensional, high-entropy space that if you have enough data, which we're slowly being able to generate more and more data to train these models, you can really grok a lot about the fundamental workings of DNA, RNA, proteomics in the cell. And it'll take a bit because, you discover stuff maybe in silico, you then do it in vitro, then you do it in lab testing, then eventually stage 1 or phase 1, 2, 3 trials. So some of this stuff won't hit for 10 or 15 years. But the very first stage, the technology there is advancing very quickly, and hopefully we can shorten that time to market and really impact, human health span and lifespan in the near future.
Sarah, what about you?
Yeah, I mean, again, I think just looking forward, I think Hirsch kind of said it well. We've kind of moved from software as a service to service as software, and so just the clear surface area that there is to cover is massive. And I think, at ICONIQ, we've invested a lot historically in vertical software businesses like Procore, ServiceTitan, and many others. And there are different inflection points that kind of enable these businesses or these industries that were typically offline to move more online. And so I think there's a number of different verticals that are going to just continue to really be disrupted. They're going to need their own tools. They're going to, be shifting in terms of what that cost structure looks like as you think through different labor shortages, et cetera. And so, whether it's healthcare or legal, broadly in the finance stack, I think even things like agriculture, you can see it really kind of play out anywhere. And I think those are the areas again where some of these large companies like an OpenAI, Anthropic that have gained a ton of market share, that's at least from what we've seen, that's not necessarily going to be as deep of where they can go and focus. And so there's a bit more of, I think, a right to win for some of these other companies to really win on, the fundamentals of the business problems that they're solving across, a number of different verticals and industries.
All right, excellent. Well, everyone, that's it for the presentation, but I'd like to thank Hirsch and Sarah. Thank you.